The National Stock Exchange, the NSE, has decided to withdraw the do not exercise facility for investors trading in the stock options segment, and this is going to come into effect from the end of the month, that is the 30th of March. Brokers have said that this move could result in traders incurring unprecedented losses on expiry day of the futures and options contracts. Let's understand what this really entails. My colleague Ankur Mishra is joining us from our Mumbai studios to tell us exactly what the implications are. Ankur. I think Ankur may not join us at the moment, but we are going to break this down with Ajay Srivastava, market expert, joining us on the show. Ajay, always great to connect with you, and do tell us now that the National Stock Exchange has been switching on and off. It's going around this do not exercise facility because October 2021, I recall, the DNE facility was taken away. It was brought back again in April 2022, and now it's gone again from the end of the month, from the 30th of March. So why this yo-yo approach, you think, Ajay, and how does that back and forth by the NSE impact options traders?
See, I think the fundamental belief is that the SEBI has been or the government has been cognizant of the increased option trading by retail people, investors. I think that's the summary. And they need to make up their mind whether they need to play nanny to them or whether they need to let them do what they want to do, is to play with options. And that's the dilemma which they have. You know, in option trading, almost 20-25% of volume now is coming from small retail trades. And that's been kind of a nagging worry to the government authorities. That is the right thing to do. Are people educated enough, sensible enough to take risk? A lot of people are losing money, and so on and so forth. So I think this is a factor which weighs in when they decide on this thing like do not exercise. Because do not exercise, really speaking, in the market today makes the option market quite illiquid, at least towards the end of the option trading expiry. Because if you do not close your in the money options, you're going to be forced to buy the shares. You may not have money to buy the shares. That's why you do options, right? The reason you do options is because you want to leverage your money into doing bigger things with the 100 rupees you have. So you can take an options on a trade of 500 rupees. Now, if 500 starts to get delivered, there is no way the investor can actually take on, and in which case the auction will take place and they will be debited with a huge sum of money by the stockbroking as well. So in net, I think it's going to result in illiquidity. But the key question is, when will the government authorities believe that you can get a 24-year-old to own $1 billion company, start $1 billion company, but when they start to take risk of few lakh rupees in options trading, we start to get worried and say, let's protect them. The actual fact is that the big investment bankers who are supposed to be sophisticated, masters of the universe, they need protection from stupidity, as Credit Suisse, Signature Bank has showed us, not the retail traders. GameStop traders never lost, became bankrupt. It's the Credit Suisse which became bankrupt. So I think the mentality is that we need to protect the young investor, the retail investor. That needs to go away and say, let people take risk with their money. They are okay. If some lose money, some will gain money. But the options market will be vibrant. India's option market is very, very narrow. Doesn't have depth at all compared to the US market. So it's a step in the wrong direction. And I don't think anybody needs protection. It should come back. And options should remain options, should not result in delivery of shares.
Risk is not really a bad thing, is what you're saying, Ajay. And at this point in time, where we are not seeing as much depth in the Indian options markets, this is exactly the opposite of what we need. That's what you're saying. But as I understand it, Ajay, and correct me if I'm wrong, when options traders, they don't have the auto square-off facility after the end of monthly options in stock option trades. It will go into the cash delivery segment, where an option trade will have to pay up the margin to take delivery. How much does it actually compromise the position of option traders, especially when they don't have the entire amount in their demat accounts? What happens in such scenarios? Do explain that to our viewers.
See, if you don't have the money, supposing you are in the money option, let's assume you have a call option in the money and you got to take delivery of the shares. Now you got 5 lakh rupees of shares which come to you. Now you don't have 5 lakh in the brokerage account of yours. That's the first problem. So what does the brokerage do? Sells off your holding in the auction market and debits you for the charges with the stock exchange levies for such trade. So you may end up in the money option may end up giving you a huge debit of the auction and the charges for not being able to take delivery. And then, of course, you spoil your reputation with the broker. He wants more margins for you. So net, you might find that in the money options also result in large losses to you. More so because, as you get closer to the, what's happening in India is when you get closer to the expiry of the option trade, the volumes drop. even if you want to square up, you may not be able to square up in the Indian market. And that's the dilemma, that you can say it theoretically that, listen, I should square up 2 days before or 3 days before. The fact is, in lots of times, you never get the volumes to square up, in which case it'll be like a forced, herding the cattle into the path of delivery and losses. So, as you rightly said, we don't have enough depth. Anyway, option traders often can't find counter options to square up their position, and therefore they say do not exercise. But if this goes through, this is going to be hell, because in the last week of option trading becomes a waste, because you need to protect yourself by saying, in the money options, let me close it right now. I may not get a chance again. So, you make it illiquid, you make it difficult, you make early closures happen. Last 5-7 days of option expiry will become almost barren for trading. It just doesn't work for an options market. Really doesn't. That's why it's called options, right? It's not called delivery market.
Ajay, that a majority of traders in the options segment, they've had margin call issues because just hitting at the subject of risk, does the DNE facility, in a sense, hold back high-risk options trades in times in the past? How effective a tool has DNE been to control the risk involved in this kind of options trade?
See, it is excellent, because the point is, even the broker can close the trade. Immediately, the broker can close the trade and he can give you the off money back to you. And this is particularly relevant for in the money. So you're really not talking of loss makers. If you're loss makers, anyway, the trade, it's automatically expires. The option is worthless at the end of the day. So we are really talking of options which are in the money at this point of time. That's really the crux of the matter. And that's what is happening with delivery, that your option may be profitable, but post-delivery, you may end up in a big loss on the trade. So options out of the money are not covered by this, because anyway, they're worthless. They're written off completely. It's only relevant to options in the money.
And Ajay, the interest and penalty, now that I understand can vary between 15 and 20% if the stock option strike goes into delivery and if the trader is unable to meet his settlement obligations through his or her demat account. So what are the chances that the size of the interest and the penalty will get revisited because of this facility now getting turned off?
See, I doubt it, because I think, the size of the penalty has the link to ensuring it's a deterrent factor to ensure the fact that people don't often default in the market. And that applies to even your delivery shares as well, that if you don't deliver, you sell your shares, you don't deliver. Now, of course, most brokerages have linkage to your demat account. It used to be in the past, trades are done by brokers who don't have linkage to your demat account and you can't deliver. That's the biggest problem which has happened in the market. So I doubt it whether they revisit the issue of penalties and all, because that's been a good deterrent for people doing trades beyond what the holding is. So I'm not sure whether they'll review this. I think they will come to review the options ban again, this whole policy statement, because they will find it doesn't work, really speaking, because you are just going to dry up the options market and not make it safer. That's a problem. And an illiquid option market is a bigger risk than a liquid option market available to everybody. So when you bring illiquidity in the option market, you're heightening the risk even for good quality investors. So not a wise decision. I think they will relook at it again and let the market flow. Let people trade. Yes, don't people make losses? And people invest in mutual fund, they made loss. People invest in LIC, they made a loss. So what's the big deal? That's the equity market all about. Some will gain, some will lose.
They turn back this facility again, and that, like you're saying, Ajay, is likely to happen. What's the best way that traders can try and avoid losses once this facility is actually withdrawn at the end of the month? What would your advice be?
See, basically, you are taking a call that as soon as possible, I need to square my trade as you get closer to the expiry. That's the bottom line. And that's a tough call to make, because you want to maximize your profit. You want to carry the options, but you carry the risk that you might become illiquid and therefore forced to. So I think what will happen is people in the money are going to prematurely encash their options and close the position and not go to the last 4 or 5 days of option expiry. I think that's a net what's going to happen to all investors who are in the money.
Great having you with us as always. Great getting your
Thank you
perspective
very much
as well, Ajay. Thanks very much for joining us on India Tonight.